Hey everyone, and welcome back to part number 10 of the Dividend ETF review series. Today we're going to be talking about DVY, which is a high yield favorite out there amongst a lot of you. So this should be a good review. Before we get to that, there's some posts on the blog if you guys want to look at that. If you want to get my book for free, you can do that on both my website and on the podcast app, Spotify or Apple. And I do have a question for you guys. So I must say I'm getting a little bored or I'm not sure bored is the right word, but it's pretty monotonous doing all these different ETFs. I don't know how many of you are really enjoying the series still. Maybe a lot of you are, maybe a lot of you aren't. I'm not really sure where everyone's at. But after this video, I'm going to be doing a review of the 10 that I've covered so far in comparison to the MTUM ETF and also the S&P 500 Index, SPY or VOO, whichever one you would choose. So if after that kind of wrap up of the first 10, if you guys want to keep doing this series, I would be happy to continue doing it. Otherwise, I can move on to a different series. Several of you have expressed interest in valuations as something to talk about. We could do that. We could do something else if there's some other item that you guys are struggling with in your investments. So yeah, let me know what you think in the comment section down below. And like I said, I don't want to just bail on the series. I would like to complete it at some point, but just been tossing around some ideas on what to do. So let me know what you think. One other idea that popped in my mind was maybe I could just put these into some kind of a book format, so I could review all 18, a little blurb on each one in a book, throw some charts in there, maybe a little bit of how to pick ETFs or how to build a portfolio out of it, or how to kind of think about that in a logical framework. So a lot of things that we could do, but if you guys are really enjoying seeing all these ETFs, by all means we'll keep going. But anyways, with that set aside, let's go ahead and talk about today's ETF, DVY. So in this video, we're doing DVY's dividend yield, fees. We'll look at the dividend history, how the distributions have grown, how DVY picks the stocks that it owns, how DVY does in bad markets like 2020, the COVID crisis, what stocks and sectors does DVY own right now, and then finally we'll look at how DVY, the ETF, has performed, in addition to how the underlying index has performed. So this ETF tracks the Dow Jones US Select Dividend Index. The assets under management are $12.3 billion. It has a pretty nice dividend yield at 4.32%, and then the expense ratio is also a bit high here at 0.39. Here's the long-term dividend history. Generally, the trajectory is higher. However, I would point out two items here that would give me a little bit of pause on this. One, this dividend here back in really kind of the very tail end of the 2008-2009 financial crisis. You do have a fairly substantial dividend decline there. And then again, recently we see the high at $3.68 back in March of 2020, and now we're seeing that start to trend lower. So as we get more dividend cuts from COVID, maybe we won't. I'm not sure exactly how that's going to trend, but a lot of the stocks in this index are a little lower quality, so we may see some cuts there. Just something to keep an eye on for this particular ETF. The strategy, this starts with the Dow Jones US Broad Market Index, which is basically every stock in the United States. It does exclude REITs, which is pretty common amongst the ones that we've seen. The float adjusted market cap has to be at least $500 million, and then the average daily volume has to be at least 2 million for the 3 months prior. After that, it's going to rank all of the securities that make it through that initial screen, which are going to be a lot of them, and it's going to rank them based upon 4 factors. So one is the cash flow to total debt. I believe this cash flow number is the cash flow from operations. I didn't look into that exactly, but just for Financial 101, Financial Statement 101, the cash flow from operations is what the company gets from operations. However, it's missing the capital expenditure portion of the equation, which is basically what the company is reinvesting back into the business, or they're acquiring other companies. Things like that are all contained in capital expenditures. So it may be a little bit overstated here to use just cash flow from operations, especially if a company is very capital intensive, like a pipeline or whatever. That could be a little misleading, but I apologize, I didn't look into that in depth, but I believe cash from operations is what we're looking at. The return on equity number, which is very important for assessing a stock's competitive advantage, that is one of the factors. The indicated dividend yield, so what has been announced, annualized over that particular company's payment schedule, that's one of the factors. And then also the 5-year dividend growth rate. So overall, pretty solid group of factors. They're basically just going to say, which company has the highest cash flow to total debt. That's going to get a ranking of 1. The second is 2, etc., all the way down to say there's 1,500 stocks that make it. That stock would get a score of 1,500, and then they're just going to basically add all these up. And then the highest 100 composite scores, or how I've listed it here, would be the lowest score. But you could flip these and use the highest number, making it. But anyways, basically the best combination of these 4 factors will get it into the portfolio. And then when they rebalance the portfolio, they're not as strict. So if a stock, say they make it in the initial index, and when they do the annual rebalance, that company now scores, say, 197 out of, basically it would be out of the top 100 if they had done it again that day. However, it does allow the company to remain in the portfolio so long as it still scores in the top 200 at least. So if it still makes it in the top 200, it's going to be held, and then they're going to basically backfill any of the stocks that were sold. Say there's 20 of the 100 were sold, then they're going to fill those in with the next highest 20 scoring stocks. And then if there's any tie, they break them by dividend yield. The diversification properties, no sector is allowed to exceed a 25% weighting. And then this is weighted by market cap. The stocks are capped at the 4% maximum weight that we've seen multiple times in the series. And then if the sum of all the stocks that are exceeding a 4.7% weighting exceeds a total of 22%, so basically you would end up with, what would that be, 5 stocks? So if 5 of the stocks are 4.7% or greater, then that's going to trigger an automatic rebalance. So now we'll take a look at the risk. This has one of the more bad, egregiously bad, upside downside capture ratios. So for every 10% that the underlying index goes up, this fund goes up 6.8%. For every 10% the index goes down, this fund tends to go down 10.5%. So less upside, more downside, not a good look there. And then again, you see the top to bottom drawdown from January to March of 2020 was 29%. Now that is ending each month, so the actual daily drawdown is probably worse, but you can see how that compares to the index, which is the value index. So not a great downside protection from this particular ETF. The stocks and sectors here compared to the Russell 1000 Value Index, we see a fairly substantial overweight in the financial services sector, no REITs as we talked about earlier. The energy sector is also a little bit over, or excuse me, not quite double the weighting in the value index. The industrial sector is another one that's fairly substantially underweighted. And then healthcare is another one that's pretty underweighted. And finally, the biggest deviation from the index is the huge position, almost 24% in the utility sector. These are the stocks within the index at this point in time. So we see a lot of very high yielding names. A ton of banks are here. So you see Wells Fargo, Citizens Financial, US Bancorp, MetLife is not a bank, but it's there, KeyCorp, Cincinnati Financials, another financial. So quite a few of those regions, quite a few of these, Fifth Third, Prudential. We got a lot of financials, we'll say that, in the top 20 holdings here. Other than that, it's not a horrible list. I mean, there's definitely been some ETFs that have looked worse than this, but once again, we see the focus on higher yield. Leaves a little bit to be desired on both growth and quality, so just keep that in mind as you look at this ETF for your portfolio. The ETF Performance has been pretty horrible. Actually, I think this might be the worst performing ETF year to date, at down 16.6%. 1 year it's down 14%, which would be an underperformance of 7.1% from the Russell 1000 Value Index, which already wasn't doing very well. So this has not done well at all for the kind of the near term, but that again is because of the technology sector doing so well. So if we look at it over a longer time period, it gets a little better. So we see the 15-year numbers at about 6% per year are basically in line with the category, just trailing by about 0.5%. So the index itself, this we can get data going back to 1992, and while the ETF itself did not exist, the ETF does track this index. So we can look at this underlying index and kind of make an assumption that if the ETF had existed that far back, this is roughly how it would have performed. So going back to 1992, if we look in the Bloomberg terminal and look for this Dow Jones US Select Dividend Index, DVY, we see that the index actually produced 10.8% per year, which is over 1% better than the S&P 500. However, again, as we talked about last time, most of this outperformance was because the market basically went up in the late 90s because of the technology bubble, and then it all popped after that. Dividend stocks did not go up as much, but they also didn't hardly go down at all. So they kind of maybe went down a little bit like this and then continued to climb higher. So if we look over this entire period, we see that the S&P 500, which is this, the bubble popped, did a lot worse. But if we start at, say, here, and then look forward, so excluding the technology bubble, we see a lot different of a picture. So here we see that this index from 12/31/2002 to November 2nd, which is when I looked this data up, underperformed the S&P by about 1.7% per year. So in more recent times, we have not seen great performance from this either index or ETF. So pros and cons, the biggest pro is that this is a higher yielding ETF, which is probably why most of you are interested in it in the first place. We do see overall consistent dividend increases. There are a few red flags after recessions when you get a lot of dividend cuts. The longer term index performance is actually pretty decent if you include from 92 to today. It does have more concentrated exposure at just 100 names, so you're going to get a lot of difference between this and, say, the S&P 500 or kind of more standard indices, which gives you the potential for outperformance and for underperformance. The exposure to small and mid caps also gives this a little bit of a different feel than you would get with some of the other dividend ETFs that we've seen. And then the value exposure over a long period of time should help this fund outperform. It's a little debatable whether that value premium still exists. Maybe it was just a kind of an anomaly for the time period in which it's been studied. I wouldn't jump to that conclusion, but some would say that. But anyways, that is generally considered a positive for future performance. The negative for this particular fund would be index performance post-tech bubble, where it has underperformed both with the ETF and the index. There are some pretty large sector imbalances with this particular fund, particularly that 24% weighting in utilities. That is quite a substantial overweight. Also quite a bit of energy exposure, which has not done well at all. It is tilted towards lower quality, higher leverage type stocks, which is something to be aware of, and that has led to its poor downside protection, which we saw in 2020. And then also it has relatively high fees versus other dividend ETFs. A lot of you have commented that you would never buy an ETF or fund that had a fee of more than like 0.3%. I would say in general, yes, you'd rather pay less fees than more fees, but the key really is to examine and to evaluate how the particular fund is doing net of fees. So even if it's a little bit of a higher fee, if it's providing you your needs, if it's giving you the downside protection or the income or whatever you're looking for, it may be worth it to pay a little bit of a higher fee to get that. Of course, we'd rather everything have zero fees, but you've got to pay for it somewhere. So don't get too worked up about it. It's definitely a consideration, but it's not necessarily a deal breaker if something has 35 basis points in fees versus like 0.07 for a different fund. That's not a huge difference in the grand scheme of things if it's something that you really are interested in buying. That's all I've got for this particular video. If you found this video helpful, I'd really appreciate a thumbs up, like button click, and if you want to get updates when my next videos come out, hit the subscribe button. Love to have you guys as part of the community. And as always, if you have questions, comments, videos you'd like to see in the future, just want to say hi, whatever, leave a comment in the comment section. I reply or try to reply to every single comment. So appreciate all of you guys leaving some feedback. So anyways, hope you guys have a great rest of your week this week.